Hello everyone. The topic I have chosen for Indian economy and policies is the twin balance sheet problem. The Economic Survey of 2015-16 acknowledged that one of the critical challenges confronting the Indian economy is the twin balance sheet problem. The balance sheets of both public sector banks and some corporate houses are in terrible shape and it has been a major obstacle to investment and reviving growth. In its recent financial stability report, the RBI also spoke in detail about India's twin balance sheet problem. As per RBI, it is the blip in an otherwise positive outlook for the Indian economy. The report further states that weak investment demand, mostly emanating from twin balance sheet problem, that is, a leveraged corporate sector alongside a stressed banking sector, is a major challenge. So, what is the twin balance sheet problem all about? A balance sheet is a statement of institutions' assets and liabilities. This applies to both companies as well as financial institutions. Even the RBI publishes its balance sheet, but the twin balance sheet issue refers to the problematic balance sheets of Indian companies and banks, meaning here both the lenders and borrowers are under stress. The problem faced by the public sector banks are linked directly to that of corporate sector. During the boom years, some companies borrowed a lot of money from banks to invest in infrastructure and commodity related businesses. But now, due to slump in both these sectors, the corporate profits have hit new lows. With low profits, the corporates are not able to repay their loans and their debts are rising at an alarming level. This is the twin balance sheet problem. What went wrong and when did it go wrong? During the mid 2000s, that is, at the time of boom, firms abandoned their conservative debt to equity ratios and leveraged themselves up to take advantage of the perceived opportunities, setting off the biggest investment boom financed by an astonishing credit boom in the country's history, mainly from banks and large inflow of funds from overseas. But just as companies were taking on more risk, things started to go wrong. One, costs oversoared far above budgeted levels as securing land and environmental clearances proved much more difficult and time consuming than expected. Second, at the same time, forecast revenue collapsed after the great financial crisis. Projects that had been built around the assumption that growth would continue at double digit levels were suddenly confronted with growth rates half that level. Third, financing costs increased as RBI increased the interest rates to quell double digit inflation. Fourth, for overseas financing, rupee depreciated, forcing firms to repay debt at much high exchange rate. Higher costs, lower revenues, greater financing costs all squeezed corporate cash flow, quickly leading to debt servicing problems. By 2013, nearly one third of corporate debt was owed by companies with an interest coverage ratio less than 1, many of them in the infrastructure and metal sectors. By 2015, the share of these companies reached nearly 40%. Which industries are the major defaulters? Basic metals, mostly steel industry, cement, infrastructure like power generation, roads and ports, textiles, chemicals, and engineering. So, what is the problem and what is the scale of the problem? Quite large indeed. Back in 1977-98, East Asian companies went through a similar problem. It turned into a huge crisis that set the countries behind a great extent. However, India's bad loan problem is much bigger than the peak levels seen in Korea during the Asian crisis. Korea's bad loan touched a peak of 8.9%, lower than India's. The Financial Stability Report 2017, released by the RBI, states that India's gross NPA stands at nearly 10%, with chances of revision of up to 12% in the future. India has the second highest ratio of NPAs among the major economies of the world. Only Italy, with 16.4% NPA, has more stressed assets. China has only 1.7% NPA, according to the IMF. As it stands, stressed assets held by Indian banks amount to around rupees 10 lakh crore or 150 billion US dollars, with PSBs having nearly three quarters of that pie. Why does this matter? For an economy to grow, its banks have to be stable. Plus, its companies have to keep planning new investments and projects. Otherwise, there would be no growth. Currently, banks are not stable as the amount of bad loans exceeded the total interest they earned as operating earnings. This makes banks very risky. If depositors start withdrawing money, a bank could easily shut. At such times, banks start lowering the amount of money it lends. This means the new companies that want to execute new projects or investments would not have access to funding. Banks have turned cautious since, and by February 2017, loan growth had hit an all-time low of 3.3%. Lower investments have been the key cause of India's slow economic growth in the past decade too. On the other side, to service their high debt and interest accrued, the corporate sector has no other option other than to cut back investments. This further inhibits the firing up of growth engine. On a conclusion, addressing the stress assets problem would require 4 Rs: reform, recognition, recapitalization, and resolution. This is the second time in a decade that such a large share of their portfolios has turned non-performing. Unless there are fundamental reforms, the problems will recur again and again. As a part of reforms agenda, government has brought in steps like 1. The Insolvency and Bankruptcy Code 2016. Second, the bank's loan restructuring schemes such as corporate debt restructuring (CDR), formation of joint lenders forum (JLF), flexible structuring for long-term project loans to infrastructure or 5/25 scheme, strategic debt restructuring (SDR), S4A to check menace of NPAs. Third, GST as an indirect tax reform to boost ease of doing business and drive the industrial growth engine. Fourth, further land and labor reforms for industries need to be carried out. Following the RBI's asset quality review, banks have recognized a growing number of loans as non-performing. This needs to be augmented and reviewed regularly. With higher NPAs has come higher provisioning, which has eaten into banks' capital base. As a result, banks will need to be recapitalized, the third R, much of which will need to be funded by the government, at least for the public sector banks. The government unveiled a massive 2.1 lakh crore recapitalization plan for PSBs in 2017, and prior to that, under Indradhanush in 2015, the government had infused rupees 70,000 crore too. The key issue is the fourth R, solution. For even if the public sector banks are recapitalized, they are unlikely to increase their lending until they truly know the losses they will suffer on their bad loan. Nor will the last stressed borrowers be able to increase their investment until their financial positions have been rectified. IBC is a good move in this direction, and first such resolution is almost complete with Tata Steel acquiring debt-ridden Bhushan Steel with a 35,000 crore offer, where they owed nearly 56,000 crore to creditors. Until these plans materialize and effected to full strength, economic growth will remain under threat.